ask you this. How do you buy capacity the right way in a very short week? That's today. Hey everybody, welcome back to Sales Chatter, and I got my man Dean with us today again. So Jeff has decided that he's not going to be on Wednesdays anymore, Dean. He's had too many different things come up, and he feels like he's being pulled in a million different directions, and I totally get that. Yeah,
That's a great problem. Great problem to have.
yeah, it is.
Good for him.
It's not a bad problem to have at all. So y'all are stuck with Dean and I. Sorry about that, I guess.
Yeah.
So Dean, I'm really interested because we got a short week coming up next week, right? We've got Canada Day plus 4th of July. So there's quite a few things happening in the market, both on the north and south sides of the border. We also have, a lot of theft and criminal activity at one of the all-time highs that we're dealing with consistently, the huge issues of double brokering lately and all this. So we've got all of these issues, U.S. logistics on the weekend going out of business. Like there's all these different pieces of the puzzle, right? And leading into this weekend, I know over the last couple of weeks, we've been having conversations about the fact that rates are going to spike and then they're going to kind of fall off the end of a cliff come July 4. So just share with everybody your thoughts. What are some of the concerns and kind of what we're looking at expecting over the next, call it 7 to 10 days?
Yeah, you started off with the right point, which is cargo theft, right? The physical theft of trailers, because you're going to have this continuing trend where carriers turn a public holiday event into a long extended vacation. That's been a trend since the pandemic started. Well, certainly in 2021. So when people started to make a lot of money, I noticed carriers were taking a lot more time off to be with family. Now, I can't prove that with data. It's just something I've seen through social media and talking to carriers, and you see it with Road Check Week, which was sort of in a funky time of the year, and then you had Mother's Day, which turned a 1-day event into a 4-day holiday, a 5-day holiday for carriers. So I think next week what you'll see on a 3-day work week, well, essentially it's 2.5 days, right? By the time people finish up on lunchtime on July 3, it's a really short work week. So if you're a carrier and you're a long distance carrier, that probably gives you the chance for maybe one load that week to get home. Because the downside is you don't want to be stuck under a load where you're promised they'll unload Friday, which they probably won't, if the ship is open Friday, which is unlikely. Doesn't say that won't happen, but what carriers are afraid of is being stuck under a load for a fairly cheap rate, but for 4 days, maybe 5 days. Because if you pick up on Wednesday and you don't unload until Monday because the shipping community has decided to take July 4 and turn it into a 4-day long weekend, what does that mean for carriers? Now, where do you get in 4 days? So if you're dispatching me out of Boston on Wednesday for Los Angeles Monday, I'm happy as anything if I don't want to be home, because that's a 4-day haul. So that works perfectly for me. But the volume of freight that falls into that category is fairly slim.
Yes.
Like the miles, because carriers want miles. If you've got a weekend on a Friday, carriers want miles, like if they want to run miles. So long distance loads become highly prized on a Friday or even a Thursday, because you can get somewhere, have your 34-hour reset over the weekend and then deliver Monday. But if it's a public holiday weekend like this, a week like this, I think it's going to cause a fair bit of disruption. And by disruption, I think carriers will turn this into another week's vacation. So what you'll see is a Road Check Week type effect where capacity will tighten because A, there's fewer carriers around, but B, demand is sort of surging as shippers move that final amount of freight into markets for the July 4 long weekend.
So Dean, if I can just clarify something, because I want to make sure everybody that's watching and listening understands this. So right now, what Dean's, and correct me if I'm wrong, but this is the way I'm hearing it. It's the capacity crunch or for this week anyways, this, call it the next 10 days, is not a fact that there's so many carriers leaving the market. It's a fact that a lot of carriers are going to extend holidays, which is going to cause this, I'm going to call it fictitious capacity crunch because the capacity is actually there. They
Mm,
just decided to take the time off, right? And I
right.
don't. So I guess maybe
Yeah.
fictitious
Yeah.
isn't the right word, but you understand what I'm saying. And then once all the drivers come back, it's going to kind of go back to normal because I don't want people to think that
Yeah.
this week is going to be representative of, say, all of July, August, and moving into
Right.
September, right?
Right. Right. Dan, that's spot on. And fictitious is probably, I call it latent. Remember we talked on the show last week about latent capacity?
Mm,
So this is, and I've just coined this term, and I should probably make sure that's the right way to describe it. But it's this phenomenon where I'm seeing a lot more carriers who made a lot more money have a lot less debt, a lot more flexibility. They can pick and choose where they run. Remember on the show a few weeks ago, I said it's almost like a lot more independents have become like Landstar,
yes.
BCOs, beneficial card capacity owners, where your typical Landstar, it's a non-forced dispatch. So you can pick whatever load you want essentially, but a lot of those folks are so experienced, so professional, so well off because they own their equipment. They can work 8 months, 4 months off. They can work six, have six off. So what I'm seeing because of the profits of the pandemic and the amount of equity that carriers were able to build in their business is a lot more freedom to work when and where they choose this year. So it's what I call latent capacity, where it'll sit on the sidelines and it doesn't have to go anywhere. Which is I've been I was the first one that sort of came out and said in reply to the doom and gloom scenarios and the bloodbath 2.0 stories, and I said, well, hold on, you're not going to see a bloodbath of capacity leaving the industry post pandemic because it was one of the most profitable periods in our history. So it doesn't make sense that carriers are going to suddenly have to leave the industry. Now, that doesn't mean capacity hasn't exited because it's not profitable. It all depended on when you joined the market. So I think what you'll see is there'll be capacity sitting on the sidelines next week because it can, it chooses to, and then it will come back into the market when things get busy again. And that's what I think we'll see next week is a tightening of capacity, not because there's necessarily a surge in demand, but because capacity is choosing to sit idle. Now, so when you add in late minute movement of shippers freight into markets, that last minute produce and hot dogs and beef and all those sorts of things, you will see a surge in demand. And we're already seeing it. So our load posts this week in dry van bumped over 1 million load posts for last week. Typically, what you see before a big weekend like July 4 is in the 2 week period, the customers of folks listening, the shippers, are positioning freight into markets, particularly dry van freight. So this week, though, will be, I think, when you'll see a lot more refrigerated freight move into markets
Mm,
because next week's going to be a short week.
yeah.
So I'm thinking what we'll see is a peak in spot rates towards the end of this week, maybe early next week. But I think if you're a shipper, you have to be moving freight this week, right? You have to have it positioned in markets this week. So I think peak demand for truckload is this week because it's a 5 day shipping week leading into next week's short week. I think rates will peak and then they'll start to fall away like they do seasonally. And I think seasonality is a good segue because I'm seeing reasonably good seasonality this year from a rate perspective. From the middle of April to July 4, rates are going to go up about 20 cents a mile. It's on the lower end of the range. Normally, April to July 4, it's like more like 25 to sometimes 30 cents. But this is a fairly soft year from a demand perspective. Um, so that's what we're seeing, Dan. I think there'll be next week will be a tough week for shippers trying to move anything. But as always, the carriers that are out there that are opportunists will make some pretty good money for those last minute desperate loads that have to move somewhere. But I think what you'll see is again a lot of trucks stuck in truck stops for 4 days and burning a hole in their pocket. That's going to be the downside of this.
Yeah, and I see that happening on every holiday. I can
Yeah.
remember early on in my career, um, as sad as it is, Dean, I never worry. Like, I'm not even going to say worried. Realistically, I never cared if somebody had to sit on a load for, like, I just never thought that way in the industry. I
Right.
was a broker.
Right.
Yeah. I mean, I guess it was just
Right.
like when I first started in brokerage 30 years ago, I find anyways, and maybe somebody watching, listening can school me on this a little bit, but the whole broker carrier thing, it was like a love hate relationship. It was a relationship of necessity over anything else.
Right.
I mean, I remember
Right.
the point where I had probably when I first started, probably the first 5 years of my career, the majority of my clients were US brokers because they just didn't
Oh,
understand
right.
how to get freight to the Canadian market. So, like the Mark
Right.
Sevens of the world, all of these come like, gosh, who else? Mark Seven. Oh, geez, even Kintetsu, like CH Robinson, like all of these companies used other, like the US side used other Canadian people just to move Canadian freight, right? And
Right. Right.
I and as you start really looking at it and thinking about it from your perspective, right? And it's typically, and again, typically what I found anyways in my career was when we didn't ask the questions, things really got held up during vacation. I mean, I remember times speaking to somebody on the
Right.
dock and not verifying and showing up and the company was just closed because of like 4th of
Right.
July or whatever.
Yeah.
And it was like in Canada, it's like, okay, there's not this 4-day lead up, right? Like it
Right.
right, like it is in the US. And so it was
Right.
one of these things where personally anyways, I could never understand. I'm like, why are these companies closed? Like, and I always thought you ordered the product to be delivered, and we would speak to the
Right.
company that was receiving it. They're like, and
Yeah.
it was just as if people would just go into this mode and forget. And I can't tell you how many times we've left drivers under loads, right?
Oh,
and
yeah.
and it
Yeah.
was it was and I guess this goes back to also, Dean, I know we've talked about this before, but I remember when I first started in the industry, it was a badge of honor to solve problems. Like it was,
Right. Right.
it was our, if we weren't solving 2 or 3 problems a week at 2 or 3 o'clock in the morning, it was as if we
Right.
weren't like a highly skilled logistician,
Yep.
whatever. And
Logistician.
there you go,
It's a
there
bit
you go.
like
Well, you
geographicality.
see, I
I
can
still
say
can't
that
say
properly
that.
because I made it up. When I don't make up the word, I don't know how to say it. But you think about that for a second, right? And
Yep. Yeah.
it's this, you know, the idea now, as I sit here, decades into my career, the idea of leaving somebody out to hang doesn't vibe with me anymore. Do you know what I mean? So it's crazy how that
Yeah.
happens. But I want to get into something
Yeah.
else here because I know that part of this conversation is the entire what happened this past weekend with U.S. logistics, the equity fund, and what happened. So if you can dive a little bit into that story, and we'll kind of play in that sandbox for a bit, Dean.
Yeah, it was I got an email alert on Reddit on Saturday night, and I'm not on Reddit like all the time. Most of my social media is Instagram and Facebook and maybe a little bit of TikTok, but I have an alert set up for any time there's something on Reddit posted on the broker channel and or trucker channel. I get to r/trucker, and I started to get these email alerts about all these drivers that were sent messages, I think via text or email, that the company had closed down. And there's some 2,000 employees in this. So by Sunday night, Freightways were reporting on it, so it had some legitimacy. The CEO put something out on LinkedIn, but essentially, the company is called US Logistics Solutions. They have well over 500 trucks. They closed their doors. The financier, 10 Oaks, the company, they filed Chapter 7 and just shut the doors. And I immediately went to their website to see if there was anything on their website that might have told us about that. And their website was on Saturday night suddenly under maintenance, and no one could get to it. So that kind of had a feel for the end of the company. Pretty big deal, Dan, because they were a specialist carrier that were moving retail freight between moving apparel and other retail goods from warehouses to distribution hubs and to malls and strip malls. So it was providing a lower cost service by pooling several customers' cargo into a single trailer,
Makes sense.
which you can see back in the pandemic, moving retail freight. This would have been a really good deal across, I think, 20 states, 18 warehouses. So they had a bit of logistics, warehousing, and then this asset heavy side of their business, moving all of these trailers around. So as that market cooled and consumer demand fell away, I think they fell on hard times. They lost their big account, which the article said Librans, which is Bed Bath and Beyond, and some of those other accounts are part of that. But that's a pretty big deal on top of some of the other big name exits we've seen. This is sort of it's not reminiscent of 2019 in that second quarter when we had record bankruptcies, but it wouldn't take many more to actually put us back in a similar space, because back then we had New England Motor Freight, Celadon, some pretty big carriers go out in 2019. We've talked about the similarities of 2019 to this year, even last year. But the reason we're not seeing that massive exit of carriers is where we started the show talking about how profitable it's been for carriers during the pandemic, and how easy it is, or how much easier it is for them this market cycle to run a little bit longer.
Can I ask you a
So,
question, Dean? And this is,
yep,
I just want your opinion on it. What do you think's going to transpire over, well, call it the next 2 quarters, right? Because July is the beginning of a new
yeah,
quarter.
yeah,
What do you think Q3 and 4 are going to bring from an exodus perspective with carriers?
yeah. I think the smaller carriers, we've seen the worst of it from an exodus perspective. I think all the marginal carriers that were really struggling will have exited, um, and I think we're at a precipice where they're starting to see light at the end of the tunnel, where rates are starting to go up. Now, we've got to see if this is sustained past July 4, but spot rates went year over year positive last Wednesday for the first time in 27 months. That is pretty big news, because rates have been negative for 27 months. Like, that's an extended period of time for rates to be heading south. They're starting to bottom out and come back up. So what I think, Dan, it means on the bigger fleet side, I think there'll be more consolidation. I think there will be more carriers like this that will want to be selling their businesses or getting out because they've maybe ramped up too much, had too much debt during the pandemic, they got too big, and then had to close down. Are we still good there on the recording? Yeah, so I think what you'll see is more M&A. We saw a little bit of it with UPS selling Coyote Logistics for eight. What was that? They bought it for 1.8, sold it for 1. So there's like almost just over a $7 billion loss there. So UPS is selling their non-profitable businesses. That's the MO of the CEO of the company. So I think you'll see more of that, where people jettison non-profitable businesses that they purchased during the pandemic. There'll be more consolidation, I think, in the broker side of the industry, that because their margins are getting compressed right now at the bottom of the cycle. Because when you're at the bottom of the cycle like this, you'd know that you were bidding contracts as the market fell last year, and now as capacity tightens, you're trying to buy capacity that's trying to go up the other direction with the rates, and your margins are getting compressed. So I think what's going to happen, Dan, is I think we're getting close to market equilibrium, where supply is kind of starting to equal out and equal demand. But I think for the rest of the year, it's going to be quite flat, because on the tonnage side of freight, the freight demand side, demand is going to be very flat for the rest of the year. There's nothing that's going to move the national needle in a big way. Produce volumes down are 20% lower than where they were in June of 2019. 20%. They're down 11% year over year, but they're 20% lower than where they were in 2019, which was a non-existent, peak season for a lot of carriers and shippers. So I think what we'll see for the rest of the year, lots of consolidation. There will be more carriers exit. I think the larger carriers that have got higher debt levels, where interest rates are causing, the cost of capital to be much higher, and I think they're suffering now from the 5 or 6 quarters of decreasing contract rates we've just seen. So if you think about it, they ramped up during the pandemic, volumes were good, rates were good, but on the downside of this cycle, everything's getting compressed because the rates have come way down, and they're trying to service debt at a much higher level, higher interest rate, and their working capital side of the business. So I think that's what you're going to see is a lot more larger carriers struggle. There'll be consolidation for sure. But I think you'll see the smaller owner operator sector. If most of the industry's got less than 10 trucks, I think we've seen the worst of those carriers leaving the industry. Looking at the data this week on the exit side of the market, we're still seeing carriers exit at the rate of about, last month we had 7,400. As of today, we've had 3,000. So we'll end up with fewer carriers leaving the market, but that's been a trend for 6 months. Every month there's fewer and fewer leaving because the worst is over on that side of it. But I think back to where we started, you can't ignore the fact that there's a lot of latent capacity out there. And I think that's what's going to keep a lid on rates. I think spot rates are going to remain relatively flat through the year because of this latent capacity phenomenon. But we have to see how that plays out. There's a definite sense that there's a pull forward of imports going on. I hypothesized that was happening when we talked about May's numbers. I'm convinced that's what shippers are doing, and that's why we're seeing really high import numbers in May. Because shippers, I think, are worried about the labour action on the Gulf and East Coast come October 1 if that agreement is not ratified. It won't necessarily mean a strike, but they'll do what they did in Oakland, right, during last year's West Coast negotiations where they red tag cranes. They lock out cranes for supposed safety reasons. And that just shuts down a whole row of gantry cranes loading a vessel or unloading a vessel. So it's kind of a go slow type thing, not necessarily a complete strike. So there's that potential, and I think that's forced a lot of shippers to think about where they reroute their import volumes, and that's going to have an impact on where capacity moves, right? Because that's if you're thinking about where am I going to find trucks to move this freight. There's some things going on in the market right now that are causing this sort of imbalance in various markets. That again, this is another thing that we had to deal with during the pandemic was people moving away from the West Coast. Now we're seeing seeing freight move back to the West Coast. So, uh, Dan, I think I was reading a story yesterday that sort of really summed up why we're seeing fairly soft demand in the market, and it was a story about Texas Roadhouse. I don't know if you read it, but it basically said if there's anything Americans love, it's cheap meat, and of course business is booming at Texas Roadhouse and Longhorn Steakhouse as Americans pull back elsewhere. These two eateries have a history of performing well during periods of economic uncertainty. I don't know if you remember a few years ago, these two were standouts when the sort of inflation weary Americans began to pull back on spending. It seems counterintuitive, but they are very good at making people feel like they're getting a good deal when they need it most. And in the quarter ending March, Texas Roadhouse sales had jumped 8.4% year over year. And this is all happening as we slow down retail spending. We're shelling out less at restaurants. Most restaurant chains are feeling like they're under pressure. Even McDonald's is coming out with the $5 meal to try and pull back customers who are sick and tired of the inflationary creep that we've all been through. A lot of companies, Dan, charged a lot for stuff because they could. Because what you're just talking about, the change that the pandemic made, I think there was a lot of price gouging going on. There was certainly inflationary pressure. And so what we're seeing is the back end of this now, where some companies that still offer good value for deal, like the average meal at at the steakhouse, Texas Roadhouse, was $22. So a steak meal for $22 is good value. But I think it shows yeah, so it shows that where we are in this downside of this market cycle, where people are reacting by spending less and looking for more affordable options. People are seeking out restaurants where there's bigger servings, so they have more to-go boxes to eat more at home. So that's changing the whole freight task. I mean, that's just one simple example. Single family home starts are, fallen off a cliff literally in May. So those numbers are way down. But we're still building more homes than we were in 2018 and 2019. But the numbers don't look good. And I think what we're seeing is this, I'll call it a bubble of activity that kind of spans from when the pandemic started to now. We're still seeing the fallout effects of that massive rise in everything from supply chain disruptions to the price of freight to the cost of labor to unemployment levels. Like that has taken a substantial amount of time to work its way out of the market. And that's where the freight market sits right now. We've got this excess of capacity that a lot of it joined during the pandemic. It's still here. And we're still seeing this fallout on the demand side where demand is still, I mean, thankfully it's soft, it's flat to sideways. I would hate to think what we'd be doing if demand was really cratering. It's down, but make no mistake, there's less tonnage out there. But Dan, it's not disastrous. Like this is still a very strong economy, but it's not like, it's not cataclysmic. It's still a very soft economy. where spot rates and contract rates are exacerbated by this excess capacity that's still in the market. Yeah, so I think, Dan, the numbers I'm watching, if someone's listening to the show wondering, well, what should I be thinking about? I think I think the shippers that have played the transactional market down, like, there's always that incentive to buy capacity on the spot market because it's been cheaper. I think this market, we saw it in Road Check Week. Rates went up 12 cents a mile in a week because this latent capacity took time off in the market because it could. It's not going to take much for spot rates to go up and rejection rates. So as soon as spot rates become attractive, you'll start to see a lot of shipper freight turn back because it's just not economical to haul. And I think what you'll see is this mad rush to secure capacity that's been ignored because you've been driving rates down. I think you could start to see, rates start, if that inflection point happens, and it'll happen quickly, because there's so much capacity that's left the market as we get to the bottom of this cycle. There's a lot of shippers out there that could be really struggling if they haven't played nicely with their carriers, and vice versa. But I think that's what you're going to see. Historically, tender rejection rates on the FreightWaves Sonar platform are around 5%. That's historically low. When you start to see that get back into the double-digit range, you'll know that spot rates are rising and carriers are increasingly rejecting more cheap freight. Now, I'll back that up by saying that replacement rates for dry van coming into routing guides decreased a bit further in the last 2 weeks. They're coming in 2.5% lower than the rates they're replacing from last year's contract. So we were talking about low single digits. They're still low single digits, but contract rates for new routing guide, new contract rates that are going into routing guides are still dropping. So that means carriers are still bidding contracts down to secure volume. So while ever that's still going on, we're still in this, deflationary period in the market where the majority of freight is still being hauled at a cheaper and cheaper rate. Now that's a recipe for disaster when the market turns, I think. And I hope what shippers are doing is they're doing more shorter bids. Like, you don't want to be locking yourself into a longer bid at low rates because that's just going to set yourself up for a substantial amount of rejections, I think.